Hello everyone, this is GD back again, and today I'll go over my process, right? I mean, most of the time this process has worked very well for me about investing in the stocks. What parameters to look at, right? I mean, if you go and ask any traditional value investor, they will say like price to earnings, price to book, dividend yield. And this value investing parameters has worked I would say until like 2005 2008, but last decade, right? I mean, these parameters have really not kind of gone up to the mark, I would say. There are new parameters that I have determined looking at the stocks that I have invested in, looking at my research, that this particular parameters, right? These parameters have worked well, and there is a reason for that, right? I mean, clean balance sheet, low debt to equity ratio, lots of free cash flow generation. So what I'm trying to convince here is, if you were to look at the traditional parameters and if you stick to that, you would not have made any returns in even in the bull market. uh, and if you have looked at the ROE, the different parameters that I have outlined here, ROE, free cash flow, even if the price to earning ratio and price to book ratio is also high, those stocks have given enormous returns, because actually you cannot really price the stock based on price to earning, price to book, looking at just only them. Obviously they matter, but just looking at that, it's difficult to get returns out of the stock market. If you look at the traditional parameters, you can still make money, but your capital is not going to grow. Like if you are kind of a dividend yield investor, I would say you could stick to those parameters and collect the dividends. But if you want to grow your capital, right, like 15-20% a year compounded for a long period of time, then that time you need to go beyond that. So when I analyze a stock, right, I don't look at price to earning, price to book, and dividend yield first. I look at these parameters first, and then I go and look at price to earning and price to book. If I feel comfortable, then I go ahead and buy the stock. If I don't feel comfortable, then I don't go and buy the stock. Like, even if I mean, let's say if something is trading at like 200 PE, and I don't want to buy, even if it meets these parameters, I don't want to buy it, I don't buy it. It's not necessary that I'll buy it, but it kind of, but if you have a good price to earnings, like let's say Warren Buffett says less than 15, price to book around 1.2 1.3, dividend yield around 2 3 4%, then buy it. But if it is meeting only these parameters, and if it is not meeting the below parameter, I would not go and buy the stock. And surprisingly, the one that is meeting this criteria right now is actually Berkshire Hathaway. And if you see Berkshire Hathaway, it has underperformed by a lot of margin, in the last 10 years. If you would have put money in Berkshire Hathaway in the last 10 years, you did not make that much money, maybe 2-3% a year, which basically, I mean, if you want to, people say that Berkshire Hathaway is basically a replacement of a cash. That's kind of true, because it has solid businesses. Undoubtedly Warren Buffett made a lot of money last 50-60 years, but I don't want to make 2-3% returns. I want to make 15-20% CAGR returns for next 10 years. So let's look at the stock. So when you go on the parameters that has given huge returns, right? So return on equity is what I mean. Let's say you put in a business where you have, let's say you put $1, right? The return on equity is how much return that that dollar is generating, right? So anything above 15% return of equity, I feel very comfortable. Anything in the high 20s, high 25, 30, excellent company. Amazon, look at Amazon. If you would have looked at Amazon based on price to earning, price to book, ever since it started, you would have never bought the stock. And I did realize this actually 3 to 4 years back. when I was looking at Amazon, actually, when it was $300, I never bought Amazon at $300 because I thought its price to earning is like, always high. But that's not the trick. The trick is the Amazon has return on equity of 25-27%. So one rule of thumb, and what I have seen in my research and investing career, is if the capital grows, which is almost near to what return on equity is. So if Amazon has consistently provided return on equity of 25% a year, the stock price will grow 25% a year. And go ahead and look at it, last decade, the Amazon stock has doubled every 3-4 years, which is like 25% of a return every year, So return on equity is the topmost parameter I look at, undoubtedly. It has to have a return of equity greater than 15%. Free cash flow, this is very important. If any business which is generating a free cash, it's a great business, that is a hallmark of a business where the business is not losing money, it's not burning cash. It is very, very important for me that business generates the cash, because that cash can be utilized and reinvested in the business. It can be paid out via dividend. It can be used for buybacks, and Peter Lynch says, I am a very big fan of Peter Lynch. Peter Lynch says, if you have a cash, it is very difficult to go broke. It is very difficult to get bankrupt, and that holds true. So it has to be a cash generating machine. We'll get to that in Yahoo Finance screen. I'll show you the stock examples. The debt to equity ratio, right? This is something that I'm not that much concerned about if it is growing company, but what I have seen is the stocks that I've picked, this debt to equity ratio is also not high. If it is taking a debt and putting it in a business and generating a lot of capital, return on equity, I don't mind it, but usually I like to stick to the stocks where debt to equity ratio is less than 1, so I will look at that as well. Growth in book value. So when you say price to book value, right, I mean, it should not just constantly remain the price to book value, like 1 to 2, but the book value should grow. So basically, when you say book value growth, so let's say today the book value is 1 billion, tomorrow next year it should be 1.2 billion, 1.5 billion. So the book value has to grow. It cannot remain constant, because if it remains constant, then stock price also going to remain constant, right? I mean, the book value appreciates, stock price appreciates. The monopoly low priced item. So this is I would say in Warren Buffett's terminology, it's called moat, right? So it has to have a monopolistic business, right? Something like Amazon, low priced item. Why do we go to Amazon? Low priced item. Why do we go to Etsy? One of my other position that I have a video posted on, because it's a niche market. It's handcraft, it's basically handmade items, very niche market, concentrate focus on markets, things like that. One other stock I like is QSR. So QSR, Restaurant Brand International, it's why? Because it has Popeye's Kitchen, Louisiana Kitchen. It has the Burger King, so many restaurants, so many places. Popeye's Kitchen is going like sales 45% in this pandemic also. You can't beat them. It's very difficult to get them out of business, and it's generating free cash flow. It's asset light business. So it's not the place where you eat at Burger King. It's not owned by them actually. They have a brand and they are doing franchises. So it's a franchisee model. So it's going to generate a lot of cash because it's not investing in real estate. It's something that the people who are buying that franchisee has to really invest in real estate, and they'll just get a cut out of it. So Alibaba, that I've talked about, what a moat, 800 million, a billion users, 800 million users, a lot of investments. AliExpress, low cost items. You won't get the items as low as you get on AliExpress. It's impossible. So that's a moat. Profit margins, this is very important. Profit margins, if you are making a sale of $1 and if you make a profit margin, let's say 30%, you are making 30 cents on a dollar. Excellent, amazing business, right? Visa, MasterCard, American Express, just fantastic businesses, just throws the cash, just throws the cash out to the shareholders. I love those businesses. So let's go and look at uh, some of the shares that I have discussed, right? So Berkshire, right? So traditional value investing, right? So Berkshire Hathaway. So look at this. If you look at the chart, you look at 5-year chart. Oh, I think it's not behaving nicely. Okay, just a second. So if you look at Berkshire Hathaway, right, 440 billion market cap, enterprise value 500 billion. Even PE is not great right now, but don't look at this PE because this year basically is kind of a pretty bad year for all the companies, not just Berkshire. Look at price to book 1.19. So traditional value investor would say, oh, Berkshire trading at 14 PE, one book value typically, right? But look at the return on equity, 2.7%. It's not good, So this equates, as I told, it equates to 3% a year return. That's what you would see in the stock chart. When you look at the stock chart, the Berkshire stock has not gone anywhere. It do have a lot of cash, so it's a value company. No doubt, a value investor will like it. Lot of cash, very hard to go bankrupt. But it's not a growth stock. It's not going to grow. Your capital 15-20% a year. Now let's look at Amazon. If you look at Amazon, look at the PE. The PE has never gone below 40 or 50. 50 minimum PE you see is 40. If you see trailing PE, it's always above 70. If you see price to book, it's 16, 18, 19. Traditional value investor will never buy this stock, but look at return on equity, 18%, right? Profit margins are low, but their volume is so high. If you make $10 billion and if you make 40% profit margin, that's well and good. But in this case, 300 billion, but profit margin 4%. Still it is making money because there is other part to look at it, right? It is reinvesting all those money in its business again, right? I mean, it's not keeping cash with itself. That's another parameter. So out of those 5-6 parameter I outlined, I not necessarily look at all 6 should be met. 3 or 4 is met, then I am good. Look at the cash, 50 billion. Look at the debt, 78 billion. So it can easily cover its debt. Look at the free cash flow, 26 billion. So even if it is having net debt of 28 billion, it can pay off that debt in 28 billion. I like it. I like it. So financials, if you go to financials of Amazon, if you look at balance sheet, look at their assets, 80 billion to 16, 131 billion, then 162 billion to 25 billion. So this is the book value. So book value per share, I mean, it's a total book value for Amazon. Look at it, it's growing 30-35% every year. You can't get the company like this. There are very few in the market. Look at the free cash flow. Look at the free cash flow of Amazon, 9 billion, 6 billion, 17 billion, 21 billion is just gushing out the cash. And guys, remember, this cash is coming after they are investing. They are investing in Alexa, they are investing in a lot of different kind of supply chain, logistics. It costs them a lot actually, but AWS is generating so much of cash for them that they are just gushing out so much of cash every year. They are increasing the free cash flow by 20%. So I like it. I like this kind of business. QSR, I'm going to do a separate video on QSR. I'm invested in this stock. I'll just make another separate video to go through the valuation, the business, everything. But look at QSR, trailing P 20p, still good P wise, book wise it's very high. But again, look at the profit margin, 12% for a restaurant business. Restaurant business, it is very difficult to get the profit margin out. Look at operating profit margin, 35%. Look at return on equity, 29%. I like it. This is one of the top stocks of Bill Ackman. I like Bill Ackman a lot and his investment philosophy. If you guys would have heard, he made like $2 billion in this crash by shorting certain parts of the market. He's a very very smart guy. We are not in that league, but even if you look at his long positions like Starbucks, QSR, Agilent, it's just amazing. Very very smart investor. He bought a Berkshire stock last quarter, but then he sold out recently, because I'm sure he might have looked at this metrics and he would have thought that it's not going to give him the money that he's looking for, the returns. Look at QSR revenue. Look at QSR. For QSR it has a debt, but as I said, if it is investing the cash and if it is generating, it is all investing all this cash in growing Popeyes restaurants, so that's okay. Look at the free cash flow, 1.23 billion. I like it. This kind of things, the free cash flow generating machines, higher return on equity, it's just investor paradise according to me. So this stock also, if you see free cash flow, you got to look at free cash flow. Look at this, every year they are growing the cash flow or at least maintaining it. 1.4 billion. And the Popeyes franchise is growing so fast that it's going to be a dream come true, going forward in next 10 years. Next, let's come to ITSE. So ITSE, I have made a video for ITSE. You guys please go and watch it. I bought this stock at $70. When I made a video, it was like $80, but it has gone into $95. I don't want to look at short terms. My target on ITSE is $320. In next 5 years, and I'm going to stick to this stock even if in the market fall. But look at HC, it is very very high PE stock, price to book is high, but then look at the return on equity, 18%. Look at the cash, 803 million. Look at the cash flow generation that it is doing, 104 million. It's like this is a growing company. This company is still not on investors radar. I would say it's kind of in a very very niche stage, but their addressable market is so high. I recommend you guys go and look at my video on HC. Look at this, the assets are growing, 580 million, 600 million, 900 million, 1.5 billion. So in 3 years they tripled their book value. I like it. I really like this kind of stocks. And then cash flow, look at this free cash flow every year. Negative cash flow in 16, 54 million, 142 million, 189 million. Just look at the pace at which they are increasing the cash flow, almost 25-30%. That's what is going to give you, if it going to continue delivering this 25% return on equity, 25% increase in cash flow, your stock returns will match. That's why I have that kind of target on HC, that I'm extremely bullish on this company. There is a Baba stock, so Alibaba, again I am very bullish on this company. You can go and look at my Alibaba video. Actually, if you see forward P, Alibaba, it's very low compared to Amazon, so it's actually, this is like value plus growth. Okay, the Baba, I'm extremely bullish. You don't get 25 P stock with 35 billion in cash, and then look at this profit margin of Alibaba, 30%, return on equity 18%. This is just excellent. Just because of the tensions with China, this stock is like lying in low 220. Otherwise this stock is $1 trillion market cap. It should be $400 stock. So if you look at the balance sheet of Alibaba, again the same parameters. Go and look at the assets. Look at this, 506 million, 717 million, 965 million, 1.3 billion. Look at this, guys. It's growing its book value like at a rapid rate. The cash flow, it's a cash flow machine. Look at this, 62 billion, 95 billion, 101 billion, 180 billion. you know, it is growing its cash flow at 60% per annum for this kind of market size, guys. It is just amazing company. It is so undervalued, because of this China tensions. Alibaba is just going to just crush it in next 10 years. I'm telling you guys, it's going to match its success, similar to Amazon, and it's going to give return similar to Amazon. I see this stock like flying very high once China tensions are over. But the point with my video is, look at the parameters, come out of the traditional value investing parameters. If you're going to go with the typical value investing parameters, you are not going to get the good returns out of your stocks. So I what I wanted to convey through this video, guys, is, just look at the growth of the company, look at the ROE, very important. Look at the free cash flow growth is important, book value growth is important. All these things you need to consider, and then you can look at P and P, price to book. If you don't feel comfortable, don't buy the stock. It's you're going to get another opportunity, down the line, maybe not in a year, but maybe 3-4 years down the line. Maybe market falls again and you can buy the stock. So keep these things on your radar. These things have worked for me last decade, and you can see it, right? I mean, the performance speaks for itself. How Amazon stock, HC stock, QSR stock have performed very well in this bull market. We need to stick to winners, right? I mean, Berkshire Hathaway, you can probably have it as a safety net, I would say, as instead of a cash, so that your, the cash, how much it gives the return right now, guys. Cash, if you go to savings account, it's giving you 1% return. It's nothing. These stocks, if you invest, if they are growing their capital, return on equity at 15%, 20%, you are going to match that returns. Where is the 1% return? Where is the 15% return, guys? In the short term, the stock market can fluctuate, but in the long term, 10 years, a decade, the stock will match the performance will match to its return equity, cash flow, free cash flow. It will come back to basic. So you just need to have patience in stock market. So I think I tried to explain the things, in the, so that you guys can understand with examples. I have done a lot of research behind this, guys. I would really appreciate if you like my channel, if you like my video, provide the comments, subscribe to my channel, and hit the bell icon, so that whenever I upload a video, you guys get the notification. I want to help everybody. I want to grow, and I want to make sure that other people also grow with me. I put a lot of hard work in doing such analysis and present it to you guys. Please let me know how do you like my video. You want me to change some format, or you have any comments, or you want me to analyze any particular stock, that you are it's on your radar. Maybe it's not on my radar, so we can share ideas with each other, and then we can help each other and grow our net worth, by sharing the examples and the stock ideas with each other. Thank you so much, guys.